A UK bond market outlook. Could bonds offer better returns in the next 12 months than they have done recently if there are prospects for things like interest rate cuts? We're going to start off by looking at the performance of some bonds. Then we're going to look at some considerations when investing in bonds. And then finally, we're going to look at a strategy for selecting either bonds or equities for part of your portfolio. I'm Ian Shadrack. I help people plan their finances for retirement. Sign up to my newsletter for free files and research updates. Since my last video on bonds 12 months ago, here's what some multi-asset funds from Vanguard have done. We've got the Life Strategy 100 that's totally in equities in the blue, massively outperforming both the Vanguard Life Strategy 60, that's 60% equity, 40% bonds, and the Vanguard Life Strategy 20, that's a massive 80% in bonds and has only grown by about 5% over the last 12 months. One thing that has been very popular has been TN25, which is a Treasury gilt yielding 0.25% and maturing on the 31st of January 2025. So you get a tiny interest payment. Most of the gains are capital, but there's no capital gains taxes on UK government bonds. So it can be quite tax efficient, particularly if you have to hold it in a taxable account. And you can see that it just keeps chugging away, rising slowly over time. However, a bond fund that has longer duration government bonds within it, such as this Vanguard UK Gilt ETF, hasn't fared as well, and the returns have been pretty much zero over the last 12 months if you exclude any dividends received. So I think that you need to split out bonds and never hold multi-asset funds, because you want to isolate how bonds are performing and what their value drivers are over time. Corporate bonds have been the top performers over the last 12 months. Here's one from Schroders called High Yield Opportunities. It has a yield of about 8% and it's had capital growth of about 6% during the last 12 months. It features in my dividend portfolio, and if you check out this portfolio review video, you'll learn more about it. These are the top performing bond exchange traded funds from the website justetf.com. And as you can see, high yield corporate bonds have done well. There's an emerging markets bond that seems to have done okay, and also a GBP ultra short bond similar to the TN25 that we looked at is also one of the better performers. The worst performing bond ETFs tend to have been the longer duration bond funds, where fluctuations in expectations around interest rates can cause wild swings in the price of these funds. So now let's look at some considerations when investing in bond funds. Bonds should be an efficient market. There shouldn't be any bargains available. The yields from bonds should reflect their risks, whether that is currency, the risk of the lender defaulting, or the term or duration risk around things like inflation and interest rates changing. And there should be a clear trade-off between risk and return as reflected in a yield curve. If bond returns are low, that tends to suggest that fees are going to matter even more when you're looking at bond funds. And this suggests you should be in passive bond funds with very low fees, less than maybe 0.1% a year. But the problem with passive bond funds is that new bonds are issued all the time, some of which could be a load of old rubbish, and passive funds are forced to buy them. And I also think that a bond index is way less transparent than something like the FTSE 100, where it's quite easy to work out what's in it and what's not. High yield corporate bond funds could be an okay investment if you have enough separate bonds within the fund to deal with any defaults. But one problem with these corporate bond funds that are high yield is that when bonds do get redeemed, you've got to find something else to replace it that is also at a very high yield, and that might be quite difficult to do because not many companies have debts out there where they're issued at around 8% or more. So past yields might not be a good predictor of future yields on such corporate bonds. One alleged advantage of bonds is lower volatility. Here's some volatility data from the website justetf.com. And I've looked at a GBP index-linked gilts ETF that has a 5-year volatility of 21%, then compared it to the volatility of one of my favorite equity funds, the Wisdom Tree Global Quality Dividend Growth, which has a 5-year volatility of only 16%. So it's kind of a myth to say that bonds are low volatility. It's really only the shorter term bonds that have this low volatility. And short term index linked bonds have a 5-year volatility of around about 8%. There might be an interest rate cut in 2024, but there's still a lot of uncertainty around things like energy prices and wage inflation, including the minimum wage, and even things like a Taylor Swift concert is blamed for pushing up prices, which seems a bit odd to me. You've also got to look at things like government spending and its own bond issuing that it's going to do, and that might influence market interest rates and hence the base rate and the likelihood of any base rate cut. So I would treat a cut as a bonus rather than something that you're banking on. I think the bond returns can ebb and flow, and for some bonds most of the returns could come not from the interest that gets paid, but from things like currency fluctuations, changing expectations on interest rates, and the perception of lower default risk. And all of this can be positive one year and negative the next. So it can be really difficult to predict what the returns might be from bonds. So my strategy for starting to select a bond fund will be to look for one with low fees, with a good long-term track record of results, and for one that's attracted quite a lot of funds within it, so it's quite large and it seems like quite a few investors are backing it. When deciding whether to select bonds or equities for a part of my portfolio, not the whole portfolio, I would use the principles of dual momentum as outlined by Gary Antonacci. And for this, you have to have absolute momentum, which means that what you want to invest in has to beat either your mortgage interest rate or some sort of return you could get on like a cash ISA. And then it also has to have relative momentum. So you're choosing bonds over equities only if bonds have greater price growth over the relevant look back period. So that will be between 6 or 12 months. So if bonds have shown higher momentum, then I put a bit of the satellite funds maybe into bonds, and if not, then I just stay with equities and I would do some back testing to see what seems to work best for me, because if you use a longer term look back, then it can take a very long time to pick up on any of the momentum that's out there. But if you use a shorter term look back, then you can get a bit whipsawed and alternate 1 month between bonds, 1 month between equities, and you're kind of continually chopping and changing your portfolio, which you don't want to be doing.